Stephen Meade back again with another Bullseye Guy podcast. Today, the case for Bitcoin to a million. I'm going to lay out my 10 factors why I think it could get there. For those of you that have been watching a while, have watched my podcasts or know some of the history, I did the case for Bitcoin to $100,000 in 2020. Bitcoin I think it was around 20, 25,000 all-time high. Nobody thought it was going to hit 30,000. And I laid out my 10 reasons why Bitcoin would make it to 100,000. Now, I missed the year by a couple of years. I think COVID and some other things had something to do with that. However, all 10 things that I talked about actually eventually came true. The number of wallets, the onboarding, the retail, the ego of people, the big guys that got in and had to defend it. But one of the biggest that took a while was number 6 on my top 10 of 2020 for Bitcoin to 100,000. And I'm going to expand on that single item, that number 6, into my top 10 reasons of Bitcoin for a million. And I think it's interesting too. I just did an article the other day. Larry Fink from BlackRock, I'm going to talk about that here in a little bit, talked about, it's going to go to 700,000. And if these things just happen, if this and this happens and these people do this, I'm like, wait a minute. It's exactly what I said in 2020. Now it's all starting to happen. So let's go through. Why do I believe Bitcoin can make it to $1 million? I'm not going to say in 2025. I think some people out there throwing this massive number out there. Oh, it's going to be 2025 or 2026. I don't know when, but I'll say within 5 years, I do believe it will get there. It could get there quicker, but certainly within 5 years, there's a chance to get to Bitcoin $1 million. And let's start with why. So the number one reason was a system and a theory I created called C2F, cash to flow. And that's what my article talked about recently, and I'm going to explain in there. There's not an article. There's a theory out there called stock to flow, S2F, by a guy named Plan B, and talks about the movement of stock and how it affected price. And years ago, I went, well, wait a minute. If you look at a company, the institutional cash reserves of large corporations, public companies, hedge funds, pension funds, sovereign wealth funds, there's a massive amount of cash reserves that these companies are holding. And when you do the research, the numbers are coming in at an estimated $25 trillion. $25 trillion. And if you think, well, that's a lot, it is. But if you think, well, what's 2, 3, 4, 5% of that? It's not a lot, but across 25 trillion, it's certainly a lot of money. But let's drill down. Let's pick a specific company. I'm going to pick on Apple. I don't remember Apple's exact numbers anymore. But at one point, I think they were saying, let's use round numbers, $100 billion in cash reserves. All right. So my number one reason I think Bitcoin will go up to $1 million is the amount of money sitting in cash reserves. Why is that important? Well, number 2, these corporations have something called a fiduciary responsibility. Shareholder sentiment and a fiduciary responsibility means you have an obligation to manage the cash and resources of that company to the best of your ability. And a lot of companies have what are called TMS and CMS. Those of you in finance know what that is. If not, I'll teach you a little acronym, alphabet soup. Stands for Treasury Management Services and Cash Management Services. And a lot of times these companies will have what's called a double sweep account. It'll sit in an account in the US and earn interest during the day. And then because banks have weird hours, it'll sweep out to Europe and it'll earn interest there, and it'll sweep somewhere else and come back. And it just moves across to constantly be earning money. If you've got cash sitting in an account, $100 billion, and inflation is going up as it is, and your dollar is depreciating, you have a fiduciary responsibility to find assets that can give you a return on that capital. You have to manage that capital properly. And by proper management, It doesn't mean risky investments. It doesn't mean crazy things in the penny stocks. It doesn't mean weird investments. You've got a responsibility. But out of your total portfolio of $100 billion, that's a pie of 100%. A company will have what's called portfolio allocation. And a portfolio allocation says we as a company or a hedge fund or a pension fund or a teachers union, we're going to take 60% into some low risk bonds that we know give a guarantee rate of return. We'll take 20% and move it into some international funds that maybe are a little more risky. We'll take 10% and move it into NYSE, New York Stock Exchange, big companies, predicted rate of return within a delta, and the volume's there so you can always get out, but it's a risk profile. Well, the companies can look at Bitcoin and determine if they want to shift 1 to 3 to 5% of their money into Bitcoin as an alternative asset, as a hedge. And that's where it starts getting interesting. The dollar amounts become fascinating. And there's been a lot of skepticism within the market. The skeptical people, Jamie Dimon, crypto's a scam, Bitcoin's a scam, it's a fraud, it's a Ponzi scheme, it's MLM, it's this, it's that, it'll never work, it'll never be a currency. Well, that's great, but I'm pedantic on wording. At the same time, Jamie Dimon is saying, oh, crypto is a scam and it'll never be a currency and it won't work. They're also building their own internal stablecoin for the digital asset to do settlement in banks. And that's important because crypto, again, another one of my podcasts, number 26 or 78, maybe, I don't know. All money's not created equal. What you use a debit card for with your $100 or $10 to buy a cup of coffee is different than what you use Swift or Fedwire or ACH for to buy a $10 million coffee company. And both of those are different than what you do to put your $100 in to buy a stock that you want to go up and down. All three of those are different functions of money and different uses and purposes. So where Jamie Dimon and Larry Fink and the BlackRock guys could say, oh, we don't believe in the asset class, they're also using the technology for financial settlement and other things that is not crypto. It's really the blockchain technology. There's a lot of conflation between crypto and everything. Blockchain's the technology. Crypto to me is the classification of the asset. Crypto to me is a glorified penny stock. You buy it at 10 cents because you want it to go to $1, not because you want to buy a cup of coffee. Most crypto is driven by greed and speculation and appreciation. It's not driven off of utility to buy a cup of coffee. But when you start looking at the asset class in the breakdown and where the BlackRocks of the world are getting and the JP Morgans and things like that, they're starting to look at Bitcoin as a different type of asset class. And it's not just Larry and I'm picking on BlackRock. It's also the sovereign wealth funds. Within the sovereign wealth fund, you've got $12 to $15 trillion globally, where again, if you're a fund manager, a hedge fund or a sovereign fund, it's the same thing. What's your portfolio strategy? What's your thesis for your investment strategy? What kind of return are you trying to get? And how do you allocate $1 billion or $1 trillion? UAE just did a great deal with the US, $1 trillion into the US. Well, that came out of their investment portfolio where they're looking for a specific return over a period of time. There's also a percentage of their allocation that might be in bonds, which are a guaranteed rate of return, and that might be in some stocks like New York Stock Exchange. And that's where Bitcoin starts to fit in as this kind of qualified asset. So it's not just sovereign wealth funds, it's pension funds and hedge funds, and all of them are starting to look at Bitcoin a little differently. And the way I look at it, again, I'm going to use the US as a market for anybody that may or may not understand. The US, for the most part, has three primary exchanges, stock exchanges. We've got what's called the OTC, the over-the-counter, pejoratively known as penny stocks. Oh, those penny stocks are horrible. Well, it depends. There's good ones and bad ones. Just like there's good startups and bad startups, and there's good big companies and bad big companies. There's good and bad and all, but an over-the-counter penny stock is more risky, but it's also easier for a penny stock to go from 10 cents to $1 than it is for $100 stock to go to 1,000. So that percentage return is a high risk, but your high percentage return is there. But that 10-cent stock could also go to a penny. It could go to zero and you could lose. So it's high risk, high reward, high return. Institutions don't really participate in the over-the-counter penny stock. It's just too volatile. They're not looking for that 10 cent to $1. They're not looking for that 10x or 50 or 100x. Their investment lens and their return profile is a little different. Let's move upstream. Now you got the NASDAQ. And NASDAQ is great. It has a lot of technology companies, bigger trade, bigger volume on the NASDAQ, more swings, little higher appreciation, and companies you may have heard of, Dell and Microsoft, and I think AMD and the microchips are on there, and a bunch of the AI companies will probably go on NASDAQ. And then there's a whole bunch of them we've probably never heard of that are in that basket of the NASDAQ. But that NASDAQ return might do 20, 30, 40, 50% or 80% in a delta. So you've got a higher return, a little less risk because these companies are a little more mature. And then we're all the way up at the New York Stock Exchange. And those are the big boys. That's your, I'm going to guess, I don't trade stocks, Apple and Walmart and Ford and Coca-Cola and all the big companies are there. And they're traditional and they're a long-term investment for most, but your delta percentage a lot of times is 8, 10, 12, 15% over time. But you have a lot of volume in a particular company. You know you can get in and out. That liquidity's there in a New York Stock Exchange stock for the most part. What does that have to do with crypto? Well, I define crypto in 3 asset classes, just like traditional stock. Down here at the OTC penny stock are most of the crypto assets. There's 1 million cryptocurrencies, 1 million. And the total asset value, all of them, is about, I'm using round numbers. There's 1 million cryptos and the total asset value is about $1.3 trillion. You're like, well, wait a minute. Crypto's worth $3 trillion. It is. Bitcoin is a singular asset that's 65 to 68% of the total value of the entire cryptocurrency market. So you have 1 million cryptocurrencies down here at the OTC penny stock, low volume, low value, low valuation, and that equals $1 trillion. You have one singular asset, Bitcoin, that's 60% plus of the entire market. But what does that mean? That means that asset of Bitcoin now has moved into an institutional evaluation where a company can look at it kind of like a New York Stock Exchange stock, right? And again, Bitcoin doesn't have employees, but neither does gold. Bitcoin doesn't produce anything, neither does gold. You can say gold makes rings, but you get my point. Bitcoin's become a singular asset that now has a track record where you can look at the rate of return, you can look at the volume, and you can do some predictions on where you think it will go. And why is that important also? Well, it allows these big companies to start looking at putting money into Bitcoin, but a lot of times they look at the wrong thing, right? So now within a Bitcoin framework, you've got this massive increase of liquidity. So as more people are trading, you've got more volume, and now it starts to look more like a New York Stock Exchange type of volume and trade. And the number of people, the number of people that hold Bitcoin just crushes by a multiple factor of probably 100 million or more, the number of people that own any one particular stock. So you've got a lot of small holders, retail around the world, but that's not the point I'm going to try and make. The point I'm going to make is when I went through the risk profile, right? Over the counter, OTC, penny stocks, 10 cents to $1. That's a massive return percentage appreciation. NASDAQ might do 10, 15, 20, 30%. You get up to the New York Stock Exchange, 8, 10, 12, 15%. Notice what I'm talking about. I'm talking about percentages. I'm not talking about price. And this is really critically important for Bitcoin. Another one of my podcasts I did many years ago, people like, oh my God, did you see Bitcoin? It was up $4,000. Like, so what? No, $4,000. I'm like, yeah, as a percentage, it was up 0.12%, and there were 600 stocks on the stock exchange that had a better percentage return than Bitcoin. Bitcoin people get caught up in the price, not the percentage. And I'm going to give you some numbers. I did some quick math. So I ran Bitcoin from the beginning a year ago. So we're April 1st, 2025 for a point of reference in case Bitcoin hits 1 million, we'll have a reference date. A year ago, right? Bitcoin fluctuates up and down, but a year ago, Bitcoin was $65,000. And now it's around 82,000 today. It was up 83, 84, 85, but it's 82, 83,000. That's an $18,000 increase. $18,000. And the other day it was up at like 90. And that's another $4,000. You're like, oh my gosh. Well, let's do some math. As a percentage return, Bitcoin's returned 27% for the year. 18,000 sounds amazing, but it's 27%. So Bitcoin is a great democratizer. The guy that puts $1 million in and the guy that puts $100 in, really for the first time in history, earns the same amount of money. The guy that puts $100 in earned 27% on his Bitcoin purchase, and the guy that put $1 million in earned 27% on his Bitcoin purchase. The $1 million guy didn't get preferential treatment. He didn't. Now, granted, his $1 million made more dollars, but percentage-wise, it's the same return. How does that correlate to Apple, right? I said I'm going to pick on Apple. Apple a year ago was trading at $168, and today it's at $222. That's a $54 increase. So it's gone up $54. Bitcoin's gone up 18,000. $54. But the percent return on that money is 32%. Apple's performed better in the last 12 months than Bitcoin has. You wouldn't know that based on the dollars and the hype and everybody. But the guy that put $1 million, again, I picked big numbers. Excuse me. The guy that put $1 million in Bitcoin a year ago would have earned 27%. Guy that put $1 million in Apple would have earned 32%. And the reason I picked $1 million, not 100, it's you can buy $100 worth of Bitcoin. Again, that's why I always say price is irrelevant. Even if Bitcoin gets to be $500,000, it doesn't matter because you can fractionalize Bitcoin down. If you can only afford $100, you buy $100. The price of Bitcoin is irrelevant to the consumer retail guy who's only got $100. Price is irrelevant. It's percentage that democratizes and evens the whole thing out. And that's the massive advantage. You can't take $100 and try and buy a $222 stock at Apple. Well, technically, you kind of can now with Robinhood, but for years, you needed $10,000 in a custody account to participate in the stock market. Crypto, blockchain, Bitcoin democratized that where the $100 guy gets the same return as the guy with $1 million. So now you've got this institutional liquidity that's coming into the market. You've got 1 to 3 to 5% of money coming across, hedge funds, pension funds. You've got this rate of return in a lens where you can look at Bitcoin in a risk class like an NYSE, like a big cap stock. It's no longer a penny stock allocation asset over here that is the risk profile is too high. The risk profile is not too high. Your delta percentage return is starting to correlate to something similar to a New York Stock Exchange. And that's led to more institutional offerings. So not only the increased liquidity, but the increased infrastructure opportunities to buy. In the early days of Bitcoin, it was hard to buy. Like we bought early, it was hard to buy, hard to sell. Wallets didn't exist. Like it was a mess. And then it got easier with some of the mobile wallets. And, you've got your Coinbase and your exchanges, but institutions weren't comfortable trying to trade $10 million on a mobile phone app. That'd be like putting $10 million in a Starbucks app and trying to buy a gift card. And you're just not going to do that as an institution. So the institutions needed regulatory clarity, but they also needed institutional platforms. And that's where the ETFs have come along and some of the trade systems, and bigger companies have started to offer institutional offerings. So basically, they can go to a hedge fund, and if a hedge fund wants to buy 5 or 10 or 50 or 100 or 200 or $1 billion of Bitcoin, those structures now exist to do those transactions, to custody it properly, to trade on the liquidity when you want and need it, and the regulatory clarity of allowing that asset and that trade to happen, especially in the US, is getting easier. It's not perfect yet, but it is getting easier. So institutional offerings, technology of ETFs and exchanges, institutional custody and framework, regulations, all of those are in my number 8, right? In case you're not keeping track, it was 5, 6, 7, increased liquidity, trade and liquidity. Number 8 is institutional offerings. I'll end up putting this up as an article and have all the numbers there. So here's number 9 for Bitcoin to a million. People are starting to understand Bitcoin is where I've always classified it. Once I understood it, I kind of missed it the first time around. It's an alternative to gold. And I know that's easy to say, but I've done this a lot of times. I'll speak at big events. How many of you know gold? Bitcoin's like gold. And they're like, no, it's not. Gold's physical. And I'm like, okay. How many of you have purchased gold? And I'll raise my hand and we say, oh, all right. How many of you actually physically own gold in your house versus a digital certificate telling you own gold? How many of you physically own gold? And the number of hands up drop dramatically. People don't put it together. They're buying gold, but they get a digital certificate. They're buying digital gold. They trust that there's gold somewhere, somebody's holding in custody for them. So when somebody tries to go, oh, well, Bitcoin's digital and gold is physical. Yeah, show me your gold. And you can't carry your gold around as easily as you can something digital. Now, there's some problems with that. I've got a very close friend, and many of you may too. The Malibu fires were tragic. A friend of mine, like we have several friends, but a friend of mine lost his gold coin collection. Some of his crypto was on the drives at the house, like just lost everything. So this custody thing is still an issue on the consumer side. But in terms of gold itself, a brick of gold might be $900,000, and you can break it into ingots and gold coins and 1 ounce and 10 grams. Bitcoin's the same thing. If a brick of gold is $900,000 or $1 million, I don't know what it is now, but an ounce of gold is 3,000. So let's say a brick of gold is $1 million. And you can divide that up into ingots and gold coins. Well, just think of a Bitcoin like 1 brick of gold. 1 brick of gold is $1 million, and you can divide it up. Not easily, but you can. 1 Bitcoin is $1 million, and you can easily divide it up in fractions and percentages, just like you're buying a little gold coin, a 10 gram or a 1 ounce. It just happens to be digital fragmentations. And just like gold's difficult to get out of the ground. There's some supposed limitations on supply. Bitcoin's got in a built-in supply. So really fascinating and super, super easy. And as an institution, it's actually becoming much easier to buy Bitcoin and think of it as an institutional asset and a hedge, just like gold, that you can buy, custody, and get out of if and when you want to and need to. The liquidity in gold is not non-ending. We've got gold companies in Dubai, and I used to take them into my business partner there, and I'd say, oh, well, so-and-so's got an 8% discount with this government out of Africa, and they've got a great deal for gold. And he would look at me and say, Stephen, there's no shortage of buyers for gold. There's no reason to give a discount. Anybody that says they're giving a big discount, it's a fraud and it won't work. And he turned out to be right every time. My point of that was, and his point was, there's no shortage of buyers for gold. And within Bitcoin now, there's no shortage of buyers, but there are shortage of sellers. And the sellers, limited supply, the holders, the hodlers, is my number 10. So when I looked at the cash to flow model, right, going all the way back up to the top, I said, well, wait a minute. If there's trillions of dollars in institutional capital, if 3 to 5% of that money starts moving into Bitcoin as is an institutional hedge. That's trillions of dollars. And I did the math. I don't remember it in here. I did it years ago, but the math of trillions of dollars going into Bitcoin with the limitations on supply and the limitation of sellers at a retail level, the numbers of people that hold Bitcoin drives that price up. And that's what can push it to $1 million. So hodlers, for those of you that have been around and know, it's not a holder, it's a hodler. And hodler stands for hang on for dear life. Why? Well, in the early days of Bitcoin, let's go back to number 3 or 4 in my list. Bitcoin acted much more like a penny stock. The volatility and swings and percentages were huge. I mean, Bitcoin's gone from sub-zero pennies to $100,000. It's a 12 billion% return since its launch. 12 billion%. And we all say, oh, we could have gotten in early. Well, if you're like me, you would have got in early and you probably would have sold and got out early because the risk was too high. But a lot of people early on were hodlers, and that stands for hang on for dear life, because they were there through the massive fluctuations and swings that occurred when Bitcoin was trading much more like a penny stock with massive volatility. Now Bitcoin's matured, just like a stock. Again, such parallels. I call it retrospective evolution. So a lot of OTC, over-the-counter penny stocks and Toronto stocks, and their goal is to grow up one day and be on the NASDAQ. They want to grow up so institutions can invest in them, and more liquidity and more investors and more volume. They want to grow up to the NASDAQ. And the goal for them, really, a lot of them, is to grow all the way up to the New York Stock Exchange, because that's the epicenter. That's the pinnacle. Bitcoin has matured to the New York Stock Exchange level. Used to be down at penny stocks. Then for a while it was mid-market. And the mid-market now, the NASDAQs of the world, is where I would put Ethereum and Solana and probably Algorand and mid-chains. And, well, is mid-chain? Yeah, like there's different ones that are kind of like NASDAQ. Bitcoin for sure is the big kahuna. You could possibly put Ethereum up there, but really it's Bitcoin has been the killer asset. Not, as Anthony Scaramucci says, the apex predator. It's not going to be Bitcoin and no others. We're comparing Bitcoin really more to gold, because the market caps will eventually be the same. Bitcoin's crushed the other cryptos in terms of valuation and market share. Totally agree. But those other cryptos serve a different purpose for raising capital and doing things, just like a bunch of stocks on the OTC and the Australia ASX and the London. And, there's stocks around the world where companies issue stock to raise capital. Most crypto projects are raising tokens to raise money. Just be honest. Quit trying to jump through hoops. You're raising the token to raise capital and hopefully build a project and build a company, not do a rug pull. So in closing, when we look at this, the cash to flow model and cash to flow theory for me is the money moves over, more institutions put capital in. It's easier for them to get in and out based on ETFs and institution and custody. They're looking at it more like an asset with a percentage delta of risk profile that they can manage and handle. And they look at it like digital gold, and there's more consumers and retail people that are holding that Bitcoin and not selling. So you've got this massive buy pressure with limited sell pressure. What does that result in? A price increase. Therein lies the $1 million for Bitcoin. When will it get there? I don't know, but I have faith that it will. I'm not going to I'll put a prediction on within 5 years. Like I said earlier, hopefully it'll come sooner, but hopefully it comes the right way. But that's it. Stephen Meade, the Bullseye Guy. That is my case for Bitcoin $1 million. I hope you own some, and I hope it gets there. Thank you very much.